Well, are the potential changes coming to the 401k plan market a good thing? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. If you got a question for me, I want to invite you to go to the website at www.prudentmoney.com. When you do get up to the site, go to the top of the page, and there is a link that will take you straight to where you're wanting to go. And make sure that you also check the box to be a part of the email newsletter list, and we can keep you posted on what we're putting out there. So that's off the website, www.prudentmoney.com. Well, I got to say that things have really changed. I think you would agree with me in our economy and in inflation. I mean, if you think back, the big stories up until just the last 3 weeks have had nothing to do with Iran, nothing to do with inflation, really, except it was a little bit of a concern. Now, of course, you've got a lot of inflation building in the prices of things, and unfortunately, and I hate to be the bearer of bad news, it's not just going to be in inflation in the gas tank. Even that's going to be a big one to get across. You'll see it on all kinds of products because so many products are tied and use oil as a part of the development process. So it's on so many things. And in fact, I read a list of this just a couple of days ago on the program. So that is what we're dealing with, and I've had quite a few questions come in about what do you do, and I think one of the things we have a human nature response is to ignore it. Now, if you're thinking, is that me? Do I ignore it? You know if you're ignoring it or not. I'll tell you. Here's the litmus test. You're ignoring it if, as of today, you haven't really checked on any of the pricing and prices of. And taking notes when you're in the grocery store. And when I say taking notes, I mean observations of what's costing what. You just have to be a smarter consumer. And most people will not take that charge, will not jump on that bandwagon of responsibility and just overspend on items. So it's a matter of really paying attention and figuring out if you can pay for it in a better way, which is a lower price. How do you do that? And it does, one of the things, and I know for a fact, when it comes to grocery shopping, because as you know, we talk about this, I do the grocery shopping in my house, and if you have to really work at comparing prices and taking prices and working to find the lowest price. And sometimes that can be a situation where it is a lot of work for 10 or 20, 30 cents. And although that may be in some cases, every little penny helps. Every dime helps. Every quarter helps. Every 30 cents helps. Every dollar helps. So kind of shift your thought process there. And I'm only mentioning this to those of you who want to fight the inflation bug. Some of you might just say, I don't want anything to do with it. I'll just deal with it, which is fine. But also, I think it's important to not only observe and watch prices change and go up, go down, and you'll actually see a lot of that as well. It's really going to be a situation at the gas pump. And so that's why I've had Tony Joe talk a little bit more about gas saving tips. You can always join Tony Joe and I on every Friday for the special Car Corner edition of Prudent Money. And we're going to be talking more about gas saving tips this coming week. So make sure that you check into that. That's all on Fridays after Friday's program. So the best thing that you can do right now, the best step that you can take, is to go through your spending. And if you've been putting it off, it's time now to do it. It's time to do the spending plan, not budget. All we want to know is information. We want to know what's costing us money. We want to know what is the price fluctuation on certain items that we buy quite a bit of. We want to know other things like, does it make sense to buy in bulk? Maybe make that trip to Costco. Costco scares me. I don't go into Costco. But you have the opportunity to spend a lot of money. But you get the idea. Just start to pay attention. And, you can take it another level. You can always cut coupons and look for specials and really do your homework before you go. So there's a lot of things that you can do to save money, especially at the grocery store when it can be just really expensive. So start this spreadsheet, the spending spreadsheet, and all you're doing is you're just making notes of what you're spending at the grocery store, what you're spending on the kids, just everything that costs, let's say, more than $5, and you can track. So cash is not a good substitute, but that you can track your spending. That's what you want to do. Then you want to end up at the end of 30 days and get a tally on what you spent. You can do this on a spreadsheet. It doesn't have to be anything fancy. You can do it or sophisticated, although I like spreadsheets. So you can do it on a spreadsheet. I would encourage you to do it on a spreadsheet, unless you can go pick up Quicken software or something like that, or all the many other software programs there are just straight on the web, and it's easy for you to maintain. I find that a lot of these programs, you download them, you start getting information put up on there, and what ends up happening is you run into a roadblock because you don't know how something works. So we want to avoid that as much as possible. So just make sure that you've got a good system set up. Start tracking. This isn't, like I said, something that is majorly sophisticated. You're just looking at where your money's going. Not trying to put you in a budget box, just trying to check to see where you can save money. And you might be surprised. I mean, I'll say one for sure, and I'm sure that a lot of people would admit this. I'm going to admit it, but I'm sure a lot of you listening would, that's kind of me. Streaming TV. If you went and signed up for everything, I don't know what that bill would look like. But I do know that every time I want to watch something and it's not on the channels that we have, I easily order the new channel. $5 or $10. But is that something that's really a good use of money? So these are the questions you want to ask. And I was talking about human nature a while ago, and why you want to be real careful and taking what I'd call the dark side and just ignoring it, because that's where you run out of time because you're ignoring it. And a lot of that is because people are maybe afraid to what they're going to find out. So get some confidence together, get some fearless attitude of the prudent steward, and jump in there and look at those numbers. And if you have any questions about how to do that, how to put that together, just make sure you go to prudentmoney.com, send me an email, and I'll get you taken care of. I really want to see, as a consumer body that listens to the program, I really want to see our listeners and users of our content really go to the next level and do better than the average person as far as dealing with the inflation. And the question is, how long is this going to last? How long is it going to go? Really tough to say. I would do very little listening to what's happening in Washington, because they're trying to spin this thing as if it's no big deal. And as long as Iran holds us hostage, it is a big deal. And gas prices can get out of control. as a main fixture of our cost. So just be prepared, and that's how you do it. You just make sure that you are tracking it and see how you can spend less. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. Let's talk a little bit about something that's happening with your 401k plan. You may be getting a marketing piece, a letter, probably something really eye-catching that's going to start talking about new opportunities in your 401k plan. These pieces of information, these marketing letters, will talk about what's called private markets and alternative investments, and that they're going to make available to you inside your 401k plan. And I want you to take a step back for just a second and think about the amount of money we're talking about that this whole industry wants to get its hands on, and how easy I think it's going to be for them to do so. We're going to talk about that so you know what the playing field's like, and you can make a bold decision as to if that makes sense for you as being a steward of what God has given to you. But we're talking $48 trillion. And I'm sure that the government's got its own place marker in there for some various funds and that type of thing. But you really want to know what you're getting yourself into. And this is I just found this article the other day, and I thought I would share it with you, as it seems that things are getting closer and closer and becoming more of a potential reality. And by the way, you remember me talking about private credit, the private credit market. Let me get to that on the other side of this break. This is Bob Brooks. We are up against a break. Stick around. I'll be right back. Hello, this is Bob Brooks. Proverbs 22:3 and Proverbs 27:12 are the exact same verse word for word. I call them the stewardship verses of risk. A prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. On the Prudent Money Radio Show, we teach about risk, how to identify it, how to figure it out, and what to do about it. We believe that to be a prudent steward, you have to be a good risk manager. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, home of the modern-day steward movement.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's Destined for Victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you've got a question for me, go to the website, and up to the top of the prudentmoney.com website, there's a link that says Ask Prudent Money. Make sure that you shoot us an email. We'll get you taken care of. That's out the website, www.prudentmoney.com. The name of this article is Private Markets and Alts, or Alternative Investments, Edge Closer to 401k Plans. Now, let's talk a little bit about this so that you know. If you've heard me, as I talked about before the break, the private credit markets, where people are rushing to get access to money, businesses, whomever, and they're paying enormous amounts of interest for this money. And they're charging enormous amounts of interest for this credit, because credit is a little bit harder to come by, especially as things start to tighten up. And so, if you're looking for that kind of credit, then that means the banks won't touch you, other lenders won't touch you, but these at maybe 25-30% will definitely give you a shot. So and then I've also talked about the private credit markets, how I feel like those are going to be the next big crisis we're going to be looking at. I think there's $1.8 trillion in those particular that particular marketplace. So, and all because of the reasons I'm going to be telling you in this article. It says interest in bringing private market investments into defined contribution plans is growing. When they say defined contribution plans, I mean 401k. But adoption remains cautious due to concerns over liquidity, fees, and fiduciary risk. We will definitely talk about that. Large record keepers and asset managers are testing structures such as collective investment trusts, target date funds to blend public and private assets. Firms like Empower and Vanguard are working with alternative managers to create multi-asset strategies designed for workplace retirement plans. Supporters argue that professional management through the target date funds or managed accounts is the most practical way to introduce alternatives without overwhelming participants. Still, many plan sponsors are taking a slow approach until there's a clearer guidance around regulation and fiduciary standards. Now, you got to know that if Vanguard's getting involved, they're also they're looking at these, and how I feel about target date funds. I think I'm not a big fan of them. But they're incorporating these target date funds in there, I think, so that they don't lose assets, which is smart. But I think, the big three, and I'll tell you what, let me back up for a second. One of the problems with 401k plans in general, that there are only really two categories available in most 401k plans, which is bonds and stocks. And if you're in the unfortunate situation that we're in today, is that you don't really get the diversification effect from bonds as you used to. Typically, if stocks were going down, bonds were going up, and you got some diversification there. And that, of course, is not so much the case in a lot of situations today. So it's one of those things where that's where this would fill that gap, because most of these alternative investments, they kind of take that position of taking it to further extreme diversification, which is a good thing. But you got to know what you're doing. Definitely have to know what you're doing. And so, in some aspects, I'm a huge fan of this idea. But in others, I look at it from the standpoint of the greed of Wall Street and the greed of these companies wanting the piece of that $48 trillion. And they'll do anything and say anything, maybe. There's people in every industry that will do this. But I think that you're going to see less regulatory emphasis and more marketing than anything at all. But here's the downside, and here's really what's going on in this. And here's what the three big problems are, and I said I would come back and mention this, is liquidity, meaning that, today, if you put money into your 401k plan, in most 401k plans, I'm not going to say across the board this is the case, but in most 401k plans, you're able to get to some of that money or pull some of that money out versus just leaving it in there because you can't touch it. These private market funds or alternative investments, there are a lot of them. Most of them are illiquid, so you can't get your money. Thus, that means that if you move from point A to point B, get fired, laid off, or decide to make a switch to another employer, you probably will not be able to, more than likely, will not be able to take that money with you. You'll have to leave it, which is not such a good thing. So here's what they do. Number one, they market big returns and then big opportunities. And they have some regulations, obviously, that prevents them from going overboard, but still they figure out a way to, you're going to read it and you're going to get the message. invest with us. We're going to make you a lot of money. And hopefully you'll see improved transparency, but I wouldn't count on it. Marketing will be enticing. The marketing will be as aggressive as they can get away with. The regulations will be laxed. They have already started a process of reducing the rules and regulations that have been in place in order to protect the investor. The marketing will, we talked about this, the marketing will be laxed. This is a gold mine of an opportunity. Once again, the number $48 trillion that they're trying to get their hands on. Marketing with them will be with a degree of sophistication, but not too much because the investor still has to understand what's going on. They will encourage full 401k plan participation. They will go up against mutual funds, and they will succeed. They'll take it's just funny, the bigger money managers take mutual funds and really do downgrade them when it's a great way to make money. It's a great way to grow your retirement. And the ultimate in peer pressure, they'll encourage you to come to meetings, come to learn more, come to workshops, bring your coworkers. And that's kind of one of those things that does really end up being peer pressure, and people end up going. But here is what they don't tell you. And the question is, do private equity funds go under and out of business? And the answer depends on what you mean by go under. Private retirement investments and private equity funds rarely go bankrupt the way a lot of companies do. Most commonly, they fail to raise another fund. They shut down after returning capital. They become zombie funds and just manage existing assets. So the actual bankruptcy rate is low, but the failure rate, not continuing as a firm, is much higher. Below are some best estimates used in the industry. Private equity funds themselves. Top performing firms that consistently raise new funds, 20 to 30%. Firms that struggle or even disappear, 50 to 60%. Completely shut down, 10 to 20%. Industry experts warn that many current firms won't exist in 5 years if they cannot raise new capital. So, when you get your back up against the wall, do you do what's right? That's the question that you hope that you get the right answer. Some estimates suggest up to 80% of private capital firms could become zombie firms that manage old investments but cannot raise new ones. Number 2, private equity portfolio companies. The companies owned by private equity funds fail more than the funds themselves. So while the fund survives, what some investments inside may fail. Private equity accounts alternative funds for private investments made inside retirement accounts, private REITs, private credit, private equity funds. I can just think of some of the bad stories I've heard about all these types of funds. Successful funds with good returns, 20 to 30%. Average returns, whatever you call that, 40 to 50%. Poor returns, capital loss, 10 to 20%. Total wipeout, 5%. Now, ladies and gentlemen, you're not going to get, and you can go back and look in history, you're not going to get these kind of statistics in the mutual fund market. Not to say it won't start happening. I'm not going to get myself in trouble. It's just bear that in mind, and also bear in mind that if you want the big returns, you got to accept the big losses, because they do, as a matter of process, happen. Key points many investors will miss. Private equity rarely disappears overnight like a public company bankruptcy. Instead, the common pattern is to fund raises money, makes investments, returns capital slowly, fails to raise the next fund, firm eventually shuts down. Now, what's interesting with these private credit companies, they are in the news and and companies are starting to go and running into a lot of problems. Well, because there is so much debt and the interest rates are not that great. So there you have it. Something else you want to definitely be watching as you continue to manage your 401k plan. And if you have a 401k plan and you've come across somebody's approached you about private equity or approached your company, I would love to hear about it. Just go to info@prudentmoney.com and tell me your story. I think that I would love to hear about it. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you have a question for me today, please go to the website at www.prudentmoney.com. Send it in because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.